Secrets, the channel for learning about trading and investing. Welcome to Markets. Next week, the weekly stock market analysis show, where we look at the technical charts and try to understand what happened in the market during the previous week and also plan for a better trade for the upcoming week that's starting tomorrow. That's August 12th, Monday, 2024. Let's deep dive into the charts. What we see here is the weekly and the daily of the Nifty. So it's an ascending wedge, right? And it has hit the top of the wedge, which is getting narrowed week by week, and it has made some retracement. On the daily lower time frames, you can see that it has dropped off the ascending wedge and consolidating. Banknifty, it's an even more narrowing weekly ascending wedge that you see on the banking index, and on the daily it has hit the top of the trend line channel and then fallen down and more space down, but it's consolidating at that space. So that's how the weekly charts are showing. So let's get to see the candlesticks. Before that, let's just summarize what's the percentage of fall, what actually happened. See, it was a gap down on the Nifty index. That's what you can immediately see. That's 1.39% close lower, 345 points down, and it's closed red. So Monday began with big gap down because Bank of Japan currency interest rate hike and related stuff, and the next day onwards it's managed to sustain that level instead of going down. It started making bounce ups, and fell into the selling pressure, and it was volatile that way. It was volatile in a W shape move, if you see at the closing price basis on the last daily candlestick patterns, and you see that it was a 3.3% multi-gap down and a 2% up move the next day, and then less than 1% up fall next day, and then Friday we had a 1% up move. So a very volatile gap down, negative closing. That's what Nifty story about last week. This all happened following. So last week was treacherous because of the Fed rate outcome that was coming, and then the yen carry trade Bank of Japan crisis, and then we had the RBI policy rate that came out, and all of this has messed up market a little bit in the short term. So banking index is now nearing 7% of correction from the all-time highs, although it's only 4.5% correction so far in the Nifty. Bank index are actually even more sharply, and if you look at the daily and the weekly charts, you can see it's week-to-week basis. It's 1.67. It's 850 points low close week of Banknifty, and it has also happened on a Monday gap down and then turning volatile and trying to stay afloat. So overall, it is expanding on the downside with a bearish bias, and the medium term you can say it's consolidating. So that's the overall brief of the price action. Now looking at the patterns of the candlestick, you can see, and this is the hammer that's formed on the weekly on the Nifty, and on the Bank Nifty also it's a hammer. Difference it's red and the green and red hammers, but a hammer indicate the size of the wick, length of the wick would indicate that it is showing that there is support on the downside, and then that's how it is bounced up. But a hammer at the top of a rally or the bottom of a rally, downside or upside, would indicate a change in trend. Could potentially be an indication of a reversal on either of the sides. So in this case, this is not exactly the top, but overall, if you see the market has been rallying up, and then it becomes negative if the price moves below this weekly candle's low, right? And that's what your gloves watch out for. Bank Nifty also, this is could be a potential reversal on the upside or the downside. So since it's a trend that's going the upside, not exactly on the top, but somewhere close to that, still maybe applicable. But it could also turn that the reversal can be on the upside as well. So what if this price is going above this week's hammer candles high on Nifty and the Banknifty both? So basically, this zone from where the rise up has bounce up has happened is a zone of previous resistance breakout zone. So that is acted as a support, which means that the change in priority bounce has worked perfectly. Now the confirmation that would come in if the price moves above this candle's high on both indices we're talking about. Change in priority bounce potential is there on the positive side, right? But otherwise, this is a gap down, clear gap down, and the gap is formed here at the low of the previous week's candle low. So that's going to be a huge resistance to take out. Nifty also, Banknifty also, the previous candle's low is going to be a major resistance on the upside. So the daily candle analysis would help you to understand what exactly happened in the 5 days of the week. We see the Monday gap down, and then it's up and down and up. Basically, it's consolidating in a very narrow range. A breach of that range will indicate for the bearishness, and a breakout from that range could take up till the gap. Right? Same exact scenario on Banknifty also. It was a gap down Monday and then going volatile and then consolidating within the range. A range bound consolidation after the big gap down is what happened. That's what I see. The bull demands are showing that it's bearish biased on both, and it's more bearish in the case of an expanding Bollinger Bands downside. So Banknifty is more bearish. Nifty is sideways, actually it's consolidating but with a bearish bias. It could turn to an expansion because it's bearish biased. So there is a slight contradiction with respect to what the Banknifty is telling. It's Nifty and the Banknifty. Right? But overall, the bias is bearish, but expansion has already happened in the Banknifty on the bear side, downside. That's a summary of that. So it's a hammer. We talked a lot about hammer. Broad gap is the gap, the window that formed because of this huge drop down. So that could be resistance on the other side. They are very powerful pro gaps. It's a bearish kicker that has happened on the weekly or higher time frame. So that increase the probability of the bearishness slightly. Now, another thing that we can notice on the low is the lower high pattern. So right, this is the lower high. So low is there, lower high is there, next lower low, lower high. So that pattern can be seen on the Nifty and the Banknifty both. Lower high, lower low, lower high, low. So unless that lower high is breached and market breaks out of that, or the lower low has breached and falls down, so that has to happen. So that happens, the direction will be more clear. Gap down and then followed by a range bound consolidation is what we saw last week. Change in priority, we talked about that. And the 20 exponential moving average is good support for the Nifty. That is gone now, it's resisting below that. Banknifty has already lost that, and now it's resisting below the 50 exponential moving average. So that way major supports are breached. And Bollinger Bands are sideways for Nifty and bearish confirmation on the daily charts for the Banknifty. So that's what it is. Moving on, if you study the momentum analysis for the Nifty and the Banknifty, we have the weekly charts on the left side and daily charts on the right side. So momentum has slipped slightly into the sideways for the Banknifty, but Nifty is halting the bullish momentum even now on the weekly charts. On the daily charts, it has already lost that, but it's trying to move up, rising up sideways is the momentum. And Banknifty also, although it has slipped in the bear zone, so it has now climbed back to the sideways zone. So although we can say it's sideways. But what about the trend? The trend indicator that we use here is ADX. ADX is turned to bearish on the short term and the medium term in the case of Banknifty and Nifty both. So the trend is turned bearish is the main important thing to make a notice of. And the momentum has turned to sideways overall. So that's a summary of that. The right side, what you see here is India VIX. India VIX is spiked 7%, but it had spiked 61% on Monday gap down. That's a big spike that has happened, but finally it's cooled off following the recovery of the consolidation. But overall, it has spiked above the 15, which is just gone out of the low volatility regime and now in the medium volatility range. So you have to be slightly cautious. Once it climbs above the 20, you have to be extremely cautious. So that's a summary of what India VIX is. India VIX is all about. It's a fear and greed index. It's a volatility index. It indicates what amount of fear and greed is there in the market. So it has gone up on Monday extremely high and then cool off a little bit, but still it's at a high level. It's a level where we have to start being cautious. It's momentum. That's about that momentum, trend, and volatility. Right. I hope you get an idea about that. Now, let's move on to understand what the open interest analysis of the options and the futures are talking about. So it's a short covering build-up, which is bullish in nature on both Nifty and Banknifty. As per the Friday's close, plus Friday had is big recovery from the Thursday's fall. So that's the short covering build-up, which is positive. But the options OI is not that positive because the PCR is not at above 1, so it's bearish. Not too much bearish, slightly bearish, you can say. That's what PCR for the Nifty and the Banknifty is saying, 0.81 and 88. Okay. Up interest is for the August 14 weekly expiry because there's a truncated week, August 15 Independence Day holidays, then August 14 is where both expiries culminate. It's truncated week ahead, so we just have Monday, Tuesday, Wednesday. It's expired just 2 or 3 days more left from the and. We have bearish signals from the option side and bullish signals from the futures option side. It's a mixed bag, but options could change. We have 3 more days, things could change. But as of now, if you see the levels, we find that the Nifty is having good support at 24,000 and resistance at 24,400. That's based on the fact that the highest put writing is seen at 24,000. Highest call writing resistance with the option writers are put in at 24,400. Second highest level is 24,300. Second level put support is at 24,300 and resistance at 24,500. Similarly, if you take the Banknifty, 50,000 and 52,000 is the range that we have, where the highest put and call writing is seen as of now. But the second level of support and resistance is at 49,000 and 41,000 respectively, where the highest put and call writing is seen. Now on the top, what we see is the resistance support levels based on the technical charts that we see here. Right. Basically, we can see that there is going to be some resistance at the 24,400 levels because it's a 20 exponential moving average. And then after that, you'll have the gap at 24,686, and then we have another gap at 24,950, 25,000. So that's going to be the resistance on the downside. For support at 50 exponential moving average can come in. Then we have the 100 exponential moving average support, and then you have the 200 at 22,200. So that's how it is similar to the Banknifty. But Banknifty exponential moving average of 50 and 100 are so these resistance on the upside. That would mean 50,800, then 51,000 also resistances. There's a gap that's coming at 51,100 nearby zones, and after that we have ratio still 52,000, and after that you will have again resistance that can pop in. And downside 100 exponential average at 49,840 is where the major support would be there, and then 200 at 48, 200 exponential moving average support is at near to the 48,120. So if you summarize, the resistance on the upside for the Nifty is at 24,687 and 24,956 after that, and then 25k. This is from the charts. Alright, supports 24k downside and 23,670, 23,341 and 23,000 in case of a big multi gap down. Right, that's what the supports are. And resistance above is at 50,881, 51,088 and 52,000 respectively in the upside. Banknifty will find supports at 49,832, 49,659 and then 49,000 is a big support. If that is breached, then you go to the 48,672. Right, that's somewhere here. So basically, these support resistance levels are basically found based on multiple factors. It can be Fibonacci retracement levels, Fibonacci extension levels, its price action level resistance zones, its exponential moving averages. It can be a combination of all of these. There's separate videos on technical analysis playlist. You can check that, how it is derived. So that's a support resistances for the Nifty and Banknifty. Moving on, we're trying to understand how the sectors have performed. So the summary is that it was down day almost all sectors except for two. It's a pharma and the FMCG just not falling too much. In fact, pharma had done well with a 1% up move and everything was falling. Even FMCG gained slightly more than 0.5%, 0.70%. So these are the two sectors which just moved up, and then they're still longish, and we could take long positions on that even now. Pharma, FMCG also is bullish in both the time frames of short term and the medium term, so therefore they could take long positions there. But apart from that, all the other sectors, IT sector, metal sector, auto sector, reality, all of them fell 1%, 2% like that. The IT sector had fallen 1.6%, 2.9% metal fall, auto fell 1.4%, reality 1.3%. That's the kind of fall that has happened. And some of them have even fallen to the bearish zones. So the metal has fallen to the bearish zones. Reality has got a short-term momentum that has fallen to the bearish zones. Stay away from all those. Right, so that's the sector analysis. You can see all of it here. Right, this is cup and handle IP get broken out but got hit. Momentum dipped, reaching towards the support the RSI 40, and this is below here. We have the metal who got deeply hurt last week, fallen to the sideways in the medium term, and the auto also hit the top of the trend line channel and fallen, but momentum is intact. Pharma was breaking out in spite of all the other sectors falling. FMCG also did okay. Momentum is still bullish, maintained on the medium term. Reality got hit back badly, and the momentum has slipped to the sideways as well. So a slip to the sideways happened in the case of metal and reality, and IT and auto is managing to sustain. FMCG and pharma is performing. That's in a nutshell. Now, if you try to understand the heavyweight stocks that contribute maximum to the index, HDFC is a clean close. Volumes are above moving average, near to that, and the fallen momentum has climbed back once again, which is very positive. This could be a range shift, and there could be a bouncer from here and another breakout from the all-time highest possibility now. So that's bullish. HDFC Bank, that was what was probably holding the market from cracking down last week. The medium-term Reliance has fallen down. It's on a downside journey. It's forming the hammer, which shows a bounce, but momentum is slide to sideways. ICICI Bank has fallen to the sideways again. So two major stocks, Reliance and ICICI Bank, as well. It has got hit, but HDFC is holding the market single-handedly. Infosys, the IT stock, and TCS also, they have got beaten at the verge of a breakout, but it is holding the momentum in the medium term, still in the bull zones. Kotak Mahindra is slipped to the sideways and always been sideways. ADC is doing good volumes, momentum is maintained, green solid bullish candle. So IDC is good, and HDFC Bank is doing good. Others are struggling in the sideways. That's a summary of the heavyweight stocks that convert maximum to the index. Okay. Let's move ahead. Total market deficit in mid cap and the small cap indices, both are maintaining the bullish momentum, although it has taken a dip. You can see a similar kind of candle with this hammer showing a recovery, and it's still not too far from the all-time high, very close by. Nothing, as if nothing has happened. That's how the broader market indices are showing. Absolutely remain in the bullish zones on the medium term. Moving ahead, we're trying to understand how the institutional participation was in the market. So that's the sad story. It's 19,000 of the 12,000 crores of selling last week. It is 19,000 crores of selling. They were selling almost every single day except probably in one day. It is selling relentlessly by the Fyers that is happening, and domestic institutional money is flowing like anything, and they're buying even more. That's what made it net positive on the FIDI. So 20,870 crores of buying from the DII. So net longs, if you see, they move down on the derivatives. You can clearly see that. On the FNO, the Fyers are bullish on the futures. That's the thing that we can make out. Even retail is also bullish, right? The last closing, the FNO data, FI data is showing that, right? On the futures, they are bullish. Otherwise, they are indecisive and mildly bearish in the case of options, index options. So index futures are bullish. That's with respect to FNO portions on the FI portions on the FNO, right? Derivatives, all FIDs moved down last week. Net longs moved down. That's what you can make out. So FIs are not bringing in cash is a worry, and mutual fund money is flying in like crazy, which is one way good, but other way it's a concern because of the fact that they've been doing this for long, and the FI is now not coming back at all. A lot of money is pouring outside is a concern. That's institutional study analysis of the fund flow telling us. We're trying to understand now the global markets, especially the US markets, and the global commodities and the currencies. So the currencies, dollar has fallen down, close red flattish. It's at 103 levels, and momentum is sideways and falling. That's a dollar index we're talking about. But when it comes to the US dollar, it has made a record high. It seems to be breaking out from that ascending wedge, and after a very, very long time, it is hit the 84 and then cool off slightly and closing at 83.93. So that's making the rupee the weaker and weaker every single day. Momentum is rising, the bullish also. So there is every possibility that now it can be in a new range of in the 84 kind of level. So which is a worrying factor. Rupee, value is going out of control. The weekend points out as of now, not out of the control. It's been central bank managed, but it's getting weaker and weaker. Crude oil has taken a dip. And this week it's taken a bounce from the trend line on the weekly chart. You can clearly see that it had 18% of down move. It's in sideways in the short momentum. It's at 77 levels, and it had corrected substantially, and now consolidating by the green bounce up. And momentum RSI also you can see it's at 40 support, and then a bounce up it happened. Very rarely it has gone down below the 40 supports. RSI we are talking about. Gold is also closed slightly down, 0.5%. It is consolidating in that range after making a new all-time high. It's a flag pattern that's forming out. It indicates that there's every potential it can make new all-time highs and break out from here. So gold is slightly down last week, so but it's still very close to the all-time high, breaking out of the cup and handle. So people are not ready to bring down the gold price because it's a hedging instrument, and then they are probably shifting money to the gold from the equity markets. It's something we should be watching out for, right? And the US markets, that's where the action happens. So following the Japan interest rate hike, the US markets also crashed. Big crash down happened, but the immediate next day recovery happened on Nasdaq, S&P 500, and Dow Jones all the indices. And all Dow Jones closed slightly red, but others are closed flattish or green. So S&P 500 is flattish. Nasdaq is 4% up. No, that's wrong. Nasdaq is not 4% up. Let me just verify that it's wrong data. So Nasdaq, if you see, it's flattish, like weekly basis. If you see the charts, it's 0.5%, 0.42. It's a mistake that's put in there. It's not 4.2, it's 0.42. So it's overall a flattish close for the US markets. It's that's what you can see. Very flattish close, but remember it had a big fall on Monday. last Monday, and then it recovered, finally making a green candle and then closing flat. So US markets have recovered is a good thing, but it also reminds us the fact that our markets are all interconnected, interlinked, interdependent, and that's why we have a global crisis and then we fall just like all the other Asian and the European and the global US markets. We also fall prey to some things that's happened outside of our markets also. So that's the importance of studying this. So overall, if it's trying to summarize, you can see that commodities, crude oil is spiking up once again, but it's still within the control level, not breaking out of that zones. And gold is also at the very top, not ready to fall down, consolidating at the top, we can say. And currency is in trouble, rupees in trouble, it's breaking out, getting to 84 levels. It's always kind of consolidating. But US markets done a big volatile move last week and then finally closing flattish, we can say, right? So that's about the global. No major cues as of now, but there is a war fear and all this in addition to the US recession fear. And so if it matters, that's floating around in the news. So you have to be cautious about all those things and have careful watch on the global markets, commodities, and the currencies. Also, in addition to what you are reading on your local listed stocks and charts. Okay, let's try to have some stock picks as an action for the next week. So you have the IndusInd Bank, which has fallen into the bear zones on the momentum RSI. So this is the short call on the IndusInd Bank with the 1:1.52 kind of risk reward. Have tight stop losses because markets have good supports and mutual fund is money. Mutual fund money is flowing in, and IndusInd Bank is not fundamentally bad bank as well. So have tight stop losses. Chartically, there is high volume selling, pushing the momentum index, momentum indicators into the bear zones, which is triggering the short call. Syngene is a long, right? Because momentum is rising up, volumes are beautiful, patterns are heading towards rounding pattern breakout potential. So 1:1.52 can be a good risk reward for the swing to 1 or 2 weeks of momentum trading. Syngene International seems to be some kind of farmer stock. IndusInd Bank, we all know it's a bank, leading bank. So that's a short and a long mix for the next week. You also have the FNO strategy, and this is a bear call calendar spread once again, because my view always has been slightly mildly bearish, and I don't want to say that it cannot move further up also. So market keeps moving up, but not too much, and it has turned out to be working. And that's what next week also. If the market falls down, no issues. You have a probability of profit of 75%, and risk is not that great, but a good range. We're getting up to 24,600 as long as that level is not breached on the upside. It's less likely to happen given the negative news that's floating around. If we can actually, if the market falls, you're not going to lose anything. Overall, look at the estimated margin requirement for one lot is just 20,000. Completely covered risk defined strategy. Just 20,000. You can increase the lot size to as many as you want. So it's a bear call calendar spread. Basically, we are selling a 44,450. That's near to the ATM calendar, near to the ATM strike call, selling that, and then a slightly higher next week's calendar you're buying as hedge. So that way nothing happens if the market falls. You'll always be gaining. Right? The profits are limited, but we will not end up in trouble when we have a big crash or something that happens. So we are calculating spread for the next week on the Nifty weekly options, FNO strategy for the next week. Let's try to wrap it up. So what happened last week, we already know. It's a gap down, Monday gap down followed by consolidation and a partial recovery, we can say. Momentum has got hit, trends also has turned negative, and we have lower line, lower hope patterns short term happening That seems to be sideways consolidating in the Nifty. So its correction is only 10 to 11% so far, the highest correction so far, and it's 49% more in Nifty and 38% in Banknifty. So it's kind of rally that we had been having. Now, if you try to bucket the various parameters against the bulls and the bears, what goes in favor of the bulls is the CIP potential. This already seems to be working. Changing polarity with the bounce up happens from the previous resistance zone, acting as a support. And the mid cap, the bottom indices are all still very close to the all-time highs. Options futures YI is still short covering, which is bullish. US markets are bounced up beautifully, and it is close flat. So only a few points for the bulls. So what is in favor of the bears is the majority this time. Lower or lower higher patterns. We'll discuss all of this. I'm just summarizing it. We have a momentum that's turned bearish. Short-term trend is turned bearish. 20 demos expansion moving average support is gone. Heavyweight stocks are falling sideways. The two of them is holding. It's HDFC and ITC. And the pharma and FMCG only longish. Other all major sectors have turned to sideways. So bearish. Gap resistance there on the upside is not that easy to take out. Bearish biased expansion green on the Bollinger Bands. Options Y is having a PCA that's bearish, and we're on the top of the ascending wedge on weekly. We're clearly seeing both the indices, and the short term we are already broken down from one of those wedges. So retracements could come in. You have to be cautious. If I was selling that kind of thing, so you have to be cautious and stay away from taking long positions from investment point where the market is heated up at the top. Right, have price stop losses when corrections comes in. Stick to your rules. Technically, market is showing some stress and it's heated up. It's at the top and it's turning sideways. So market view is slightly bearish. Right. So global cues, Russian inflation, war, and all these things could screw up all the technical analysis when black swans happen. So you have to be cautious about that. You should have portfolio hedges and push and level hedges every time you have. Or like positions carry forward in derivatives and as well as in the options, as well as in the stocks. So there is a hidden bug allegations against this SBI chair that's floating around, which is beyond prediction whether how the market will react on Monday. Could be volatile, and if it is on the negative side, that may be an opportunity to invest. Is what we have to look at it. In SIP more or in lump sum, depending on your appetite, risk appetite. So the next week, 23,500 is 25,000 is the levels that I look for. The range 49,000 and 52,000 is the range that I look for. The higher and the lower and the higher on the Banknifty side. So as long as this 24,000 and the 52,000 is maintained, then we may have a rally. It continues. If that is not maintained, then it's correction time. And the corrections could easily extend to 10, 15, and 20% easily. Although 20% corrections are not happening in the market for a long time, all that could happen because valuations have risen, people have made money. The market has skyrocketed to beyond all imaginable levels. From 28,000 we have flown like anything to 4,000 points up to 25,000, 5,000 points up, just like that in the matter of a year. So it is heated up. It has to shed some of that, so it can happen anytime, Hindenburg or not, or it can be any severe reason. Market just is looking for a reason. It is heated up and it just does that and then bounces up again. As a trader, we have to be careful about not exposing or having negative positions. Always hedge your positions as well as the portfolio level as well. You should have hedging strategies. Have a look at the playlist. There are a lot of videos regarding to that. You can also use this hedging for making rental incomes during the market downfalls and upsides. Right. So check out that also in the playlist. So always play it safe. So in short, you have to be slightly cautious. There are some negative news flows floating around with respect to recessions and Japan, Bank of Japan, interest rates, recessions, rate hikes, and wars, and all this news is floating around, and market is also showing some stress and selling pressure here and there. So that's a time when you have to have tight stop loss and stick to your rules, and always find opportunities when the market is making deeper corrections. That's all I have. I'm also present in all the social media channels, especially Twitter or X, where I do the postings on daily basis. So you can subscribe to that as well. But there's YouTube. This content, if you like, you subscribe and share to friends and colleagues, and put in your feedbacks and click on the like button if you like. That's all I have. Thanks for watching. Happy trading. Happy learning. Bye bye.